ONGC, uh, Oil and Natural Gas Corporation Limited. So that is what we want to cover in this particular session. So India's largest oil and gas producer and a key player in the country's energy security. So this is what we'll pretty much cover in this particular session. So history of ONGC, their business model, financial performance, and the strategic initiatives, the future potential, valuation. So all of that will be covered in this session. So let's start with the history of ONGC. Established in 1956 by Government of India, obviously it's a PSU, so government company, uh, to explore and produce oil and natural gas for the nation. Started in 1956. So it's been like almost 7 decades, 7 to 8 decades now. So discovered Mumbai High in 1974, India's largest offshore oil field and a turning point in energy independence. So that 1974 was the turning point for the ONGC. Expanded operations to refining and petrochemicals. Later on, they entered into the global oil and gas projects through ONGC Videsh. Today, ONGC produces over 70% of Indian crude oil, 60% of its natural gas. So you can say like ONGC is almost a monopoly when it comes to crude oil or natural gas for that matter. So it is the market leader and kind of a monopoly. Coming to the business model of ONGC, so the first part is the exploration and the production, E&P. So basically ONGC searches for and produces crude oil and natural gas in India and abroad as well. So overseas arm ONGC Videsh operates in 15 plus countries, like for example Russia, Mozambique, Vietnam, Brazil, and many other countries. So that is their first way of generating revenue. They explore and produce crude oil and natural gas. Second is they refine it. So refining and petrochemicals. So they have stake in HPCL, MRPL for refining operations. So petrochemical production through ONGC Petro Additions Limited. So OPAL is nothing but where they generate this petrochemical production. That is their second. They explore, they refine, they are into petrochemicals as well. Next part is renewables and new energy. So they are making heavy investments into solar, wind, and offshore wind power as well. So targeting 10 gigawatt renewable energy capacity by 2030. So they are making massive investments when it comes to solar or wind energy, which is renewable energy. Of course, hydrogen, gas, so on and so forth. So if you look at the revenue streams, crude oil sales to refineries, so then natural gas sales to power, fertilizer, and industrial users. So basically they are selling crude oil to refineries. That is one way of generating revenue. They are selling natural gas to power, fertilizers, and all the industrial users. So, and of course, via their subsidiaries, they are also selling fuel, HPCL, MRPL, and all. They are also selling fuel and petrochemicals as well. Looking at the global presence, projects in more than 15 countries. Of course, ONGC Videsh is one of their subsidiary which takes care of overseas operations, which helps diversify income and reduce dependency on Indian fields. Now, this is important. Strategic initiatives of ONGC. First is their domestic production boost. So, major upcoming projects in KG 98 by 2 and western offshore fields. So, this is near coastal Andhra Pradesh, that is, Bay of Bengal. So, this is one of their biggest, projects. And of course, they are investing a lot of money into this particular project as well. So investments in enhanced oil recovery to maintain output from matured fields. So of course they are trying to invest a lot of money into their existing wells as well, so that they can enhance that oil recovery. Renewable push, like I already said, they are scaling up their solar and wind capacity. Offshore wind projects under evaluation. So they are, as you know, like for example, solar or EV is going to take some market out of this oil and gas. So there is value migration which is happening from non-renewable energy to renewable energy. For example, oil and gas is a non-renewable energy, and which affects the environment, cause pollution and all. So the better alternative would be EV market, or let's say solar or wind. That would be a better alternative and lower carbon footprint. So ONGC is also in that pivot mode. So they are also strategically, aggressively investing their own solar setups, selling their own wind capacity and all. Third is overseas expansion. So Mozambique gas project expected to start in the next 3 to 4 years. So this is one of their projects. This project is for natural gas, LPG, LNG, I guess. It is for LNG. And this is near African area, like near Indian Ocean. So this project is for natural gas. So expected to start in the next 3 4 years, and which can give them the production capacities for more than 20 years. So once this particular projects starts, so there will be a enormous flow of natural gas for ONGC. The production capacity is like for more than 20 years, which is strengthening partnerships in Russia and Europe. Of course, they are this particular Mozambique is considered as African, one of the African projects. Of course, they are doing some projects in Russia as well. Coming to the challenges and risk. So obviously, crude oil or natural gas, volatility in global crude prices directly impacts not just revenues, but it will impact the margins as well. So by default, crude oil or natural gas is cyclical. So demand and supply will, with the demand and supply, the price fluctuates. The next is high exploration cost. Recent written offs at 9,826 crores versus 5,560. So you can say close to 10,000 crores were written off this year, which is exploration cost. We will get back to that exploration cost going forward, but here that is also one of the challenge. In the current year, they have written off almost close to 10,000 crores. Last year, it was somewhere around 5,500 crores. Next is declining output from aging fields without timely upgrades. So obviously they have their previous wells which are going dry. So optimizing the older wells is one issue. That is also one challenge. Coming to future growth prospects, production growth from KG Basin and overseas assets. KG Basin is nothing but that Bay of Bengal project. So diversification into renewables to reduce oil dependency, that I've already covered that. So ONGC also is investing into a lot of solar projects, wind projects, hydrogen gas projects, uh, renewable energy, refining and petrochemical integration to improve margins. So again, they are changing their production, product mix to kind of boost the margin. ONGC. So if you look at the P&L for ONGC, you can see in 2024 there is a drop in revenues, but the good news is the current numbers are really good. So from 5,91,000 crores to 6,63,000. So sales went up significantly. So that is one good news. So sales growth is intact. But if you look at the margins, right from 2014 to 2025, that's more than 10 years of data, you'll find I mean huge fluctuation. For example, 2016 operating margins were somewhere around 32%, and 2023 the margins are 12%. So highest is 32, lowest is 12, which is 2 years back. And if you look at the current margins, which is close to 13, so you can clearly say it is at all time low, because 12 and 13, there is, I mean, the difference is not that big. So you can still consider right now the margins for ONGC at an all time low. So clear indication that it is at the bottom of the cycle. But whether that cycle, what is the reason for that bottom? Is it structural or is it cyclical? And you can see the sales are at all time high, but if you look at the net profits significantly dropped compared with last year, because the margins also dropped. So now let's try to identify the reasons on why the margins dropped. One, first and the foremost, commodity price cycles. It is oil and gas, it is natural gas. So crude oil, we can say, so crude oil fluctuates, depends, uh, in a good cycle the prices are very high, in a bad cycle the prices will be at the bottom. So that's one factor, one big factor, which is a cyclical factor. So ONGC margins are heavily influenced by global crude oil and natural gas prices. For example, in 2025, realization, that is price per barrel, were slightly lower compared to the previous year. Uh, what is the current price? I think it is $66, I guess, per barrel. 65, $66, the current price. But if you look at the historical data, there was, there was a time where per barrel the cost was $100, $120, $130. And of course, there is a time where per barrel it was $50 also. Right now it is at 66, I guess. The last time I checked, it was somewhere around 65, $66. But general, if you look at the average, the long term average is somewhere around 80, $85. So it is always cyclical. So the price always fluctuates, and it can go up to $100 per barrel. It can come towards $50 per barrel. But on an average, if you look at the price, it is somewhere around 80, $85. The current price is $66, which is a clear indication that the prices have gone down and which impacted the margins for ONGC. This is normal up and down movement tied to global oil demand, supply disruptions, and OPEC, OPEC decisions. Mostly Middle East countries are basically that OPEC, comes under that OPEC. So OPEC decisions, not a permanent decline in the company's efficiency. So you cannot punish ONGC for global crude oil prices change, which is cyclical in nature. So one reason for the drop, that is margin drop, is its cyclicality. That is one. So which is temporary, it will revert back. The second reason, exploration write-offs, which I would say is temporary. So in 2025, ONGC incurred round figures, let's take round figures, close to 10,000 crores in exploration write-offs versus 5,500 crores in the previous year. Now, what is this explanation write-offs? Obviously, they need, for continuous production of oil and gas crude, they have to explore various, places. So that is investment from ONGC. So they spend a lot of money. They send machinery. They send equipment. So maybe a temporary, equipment is placed over there. So this is all investment, and it incurs a lot of money. But after doing all of this, what if the well that they found is dry? They found something, but it is dry. So the investment will be written off. So that well is not going to benefit ONGC because there won't be any production. So ONGC spends a lot of money, not just ONGC, any oil and gas exploration company spends a lot of money to explore various places so that they can find the next big well. So this is part of their business. This year they incurred 10,000 crores. Maybe next year it will be only 2,000 crores. So it depends. So this is one of their gambles. So they keep on gambling in many places. They spend money. If they get oil, well and good, or else that money will be written off. In this year, it is 9 close to 10,000 crores. That is one of the reasons the margins are down. Last year it was only 5,500. But this is again temporary. So this is again nothing related to efficiency of business. This was due to higher spending on exploration and some unsuccessful wells, which is dry wells. Such write-offs hurt margins in the short term, but are part of exploration business cycle. So if they want to survive, they have to find new wells. So they keep on exploring and they keep on spending money for exploration. So it is part of their cycle. Next, cost pressure from new projects. So like I already mentioned, they are spending money on new projects as well. So since the project is very new, but setting up cost in the initial phases is very high, because once that economies of scale kicks in, the unit economics will be completely changed. But right now it is only incurring depreciation cost, in interest cost, and the sales figure is very low, so almost nil. So cost pressure from new projects. So depreciation and interest costs rose as new field like KG Basin started commercial production. So these costs are front loaded over time. As production ramps up, unit costs will drop, improving margins. So temporarily the current margins have dropped, but the good news is they are spending, or they are trying to set up new projects. So right now those projects are not operational at full scale. So because of that, the unit cost is very high over there. But once the production capacity is running at full capacity, then obviously the unit economics will change. Economies of scale will kick in. So obviously the margins will be improved. So which is a good news. In short term, the margins are taken a hit, but in the long term, it's a good news. So once that starts, we can see significant improvement uh, from this particular projects. Fourth is no structural weakness. So operational efficiency, reserves base, and core production capacity remains intact. So if you ask me, is there any structural reason for the margins to drop? Nil, absolutely nil. No structural reasons. Everything is working at, I mean, they're fully optimal in terms of operations. But the only reasons is the cyclic, sorry, the cyclical and all the temporary reasons which are bringing the margins down. So ONGC still maintains strong control over lifting cost. That is cost of extracting the oil and gas. They are still maintaining their cost. They are really cost effective, but where they are losing money is on the new projects. That is where the margins are going down. The oil prices have come down, so because of that, uh, temporarily they are facing issue with the margins. So conclusion, so the margin drop is largely cyclical, driven by, these are the factors, driven by low crude oil prices, which is cyclical, temporary exploration write-offs, which will stay forever because they need to explore. So that is going to stay. In some years it will be high, some years it will be low. Initial cost of new projects, again, this is not going to stay. Once the projects are fully operational, this cost will be gone. So crude oil and new projects, you can say, once, I mean, they get better, the margins will improve automatically. So if oil prices recover and production from new assets scale up, margins should rebound over the next 1 2 years. Of course, slowly the margins, you will see that recovery in margins over time. So that is what I wanted to cover in terms of ONGC, but of course we need to cover the valuation as well. So I hope you can see the Excel here. So as you can see here, the revenues that I am expecting for ONGC is not very high, because it is already producing 70% of crude, 60% of natural gas. So, and it is close, I mean, almost a monopoly. So, it is not a young, high growth company. So, what I am expecting is there will be 2 to 3% volume growth eventually, 2 3% volume growth, maybe 3 4% inflation. So, overall, I don't think over a long period of time, ONGC can maintain 10%, 15% growth. I don't think so. If it can generate, well and good. So that will be a good news for investors. But realistically, I just want to be very conservative. 2 3% volume growth. On the top of that, maybe 3 4% inflation. So maybe 5 to 7% expectation for next 10 years would be reasonable. But I am still going with only 4.7% growth. ONGC, the last 10 years, the numbers are like 15%. Last 5 years, it is 11%. Last 3 years is also 11%. So 15, 11, 11. So I should have taken at least 10% or 9%. I am still okay with 5%. 10% also I can take. But chalo, you already know that I'll be very conservative. So I'm only taking 5%. Next is margins. Like I said, once the crude oil prices goes up, once the new projects, that assets start scaling, the margin should go up, right? Current margins are 8%, but my target margins are only 10%. So I should have kept it at 12% or 15% to show that significant boost in margins. But again, I want to be conservative. Margins will grow. It can go to 11%, 12%, 13% also. But chalo, I still want to be conservative here as well. 8% will improve to 10%. So if I keep it at 12, from it will go to 500 and all. But it's okay. At 400 also, it is still undervalued, right? So that is the reason I am being conservative. So only 10%. So remaining, of course, target sales to capital, I am just taking the long term average and all. So, and one more thing you need to understand is there is 30,000 crores of cash on the balance sheet. So there is 30,000 crores cash. Of course, first I'll show you the market cap. So the current market cap for ONGC is close to 3 lakh crores. That is the current market cap. There is 30,000 crore cash, which is 10% of market cap. Non-operating assets. Like I said, these are long-term investments. So you can go and check on the balance sheet, you will find it. In the annual report of ONGC, you will find, so there is a big list of all the investments that this company has made, but 92,000 crores is long-term investments in various stocks, in various subsidiaries. For example, they have stake in HPCL, MRPL, so on and so forth. They have many subsidiaries. Worth of that is close to 92,000 crores. So if you just add up these two numbers, so close to 1 lakh 30,000 crores, 1 lakh 22,000. So let's say 1 lakh 20,000. Out of 3 lakh crores, this is 1 lakh 20,000 crores. So you are getting this almost as free, like as a bonus. 30,000 cash, 90,000 some investments, 1 lakh 22,000. So remaining 1 lakh 80,000 crores is what you are actually paying for. So that is what it is. So you are, I mean, why I'm covering this is basically there is some safety cushion. So up to 1.2 lakh crore, you have additional assets and you have a monopoly business on the top of that. So my valuation is somewhere around 412. If I want to, I can increase the sales growth a bit or increase the margins and I can raise the value per share, but I don't think that is necessary because with conservative numbers, I still get 43 44% margin of safety. So, what is the point of raising my assumptions? So, that is significantly undervalued, and of course ONGC is one of our recommended stock. It is still in the buying zone.